All right, so welcome to session 9 in a session 11 in our discussion for the day. A sec, it's like I'm getting some feedback here. Yeah, I think I should be good now. Should be good now. Should be good now. Give me a sec. Give me a sec. Mm. Mm. All right, so welcome to session 11 in our discussion, and we want to moving straight up into discussion, starting with the issue in respect of the cash flow statement. And we're going to be having an extensive session today. We're going to try to look at the cash flow statement both on from the perspective of the financial reporting students, that is the basic cash flow statement preparation, but also from the perspective of the corporate reporting students as well, where we are going to be looking at the consolidated cash flow statement. So it's actually going to be in that particular regard. Now, the key issue here is that for financial reporting students, you're going to be having you could have a dedicated question on the financial statement preparation when it comes to dealing with the cash flow statement, and it's a 20 mark area that the examiner can throw at you. However, in the corporate reporting, what's going to be happening is that under ratio analysis, we could have a question in relation to interpretation of the cash flow statement. So the examiner can access to interpret the cash flow statement, and that is part of the ratio analysis that we need to know about when it comes to what is going to be happening in the corporate reporting class. Then we can also have in the question one a dedicated question on the consolidated cash flow statement. That is the preparation of the consolidated cash flow statement. So it's important. This is a basic issue for financial reporting students. Then it is also a question that the examiner can throw at us for corporate reporting students. So that is what we want to look at, cash flow statement, and that is IAS 7. Now, one thing that we need to understand is that the idea about the preparation of the cash flow statement became real, and the purpose is simple. It is to try to reconcile the statement of profit or loss. We are trying to reconcile the statement of profit or loss with the statement of financial position. That's the job we are trying to do when we are preparing the cash flow, reconciling the statement of profit or loss to the statement of financial position. Now, what does that mean actually in principle? It simply means that we are trying to reconcile the profit or loss from the statement of profit or loss account to the cash or bank balance on the face of the statement of financial position. That's all we are trying to do. Now, why is this important? The preparation of a cash flow statement came to light because of the fact that entities make profit, and the average shareholder and stakeholders think that profit is equal to cash. Okay? Profit is equal to cash. But one thing you need to understand is that profit is not equal to cash. What does that mean? It means that from the profit or loss account, an entity could record a profit of, say, $10 million. But then we go to the statement of financial position only to find out that the entity is having a bank overdraft. What does that mean? So the average investor was like, what the heck? We made a profit of $10 million. Why do we have bank overdraft on the face of the statement of financial position? Or probably the entity made a loss, but then has a huge cash balance sitting on the face of the statement of financial position. So that was the contention that came, that it was like, okay, how then do we do this? Because you see, the fact that the entity made a profit of $10 million, like we said, profit is not cash. It doesn't mean that money is sitting down waiting for us, because probably the entity acquired some assets during the year. Probably the entity disposed of some assets during the year. Probably the entity has to pay some suppliers during the year. Probably the entity issued some shares during the year. Probably the entity had to repay some of its loan notes during the year. All of those things are not covered in the profit or loss account. Instead, their implication will be felt in the statement of financial position, which is going to be showing the cash or the bank balance. So this is the premise on which the cash flow statement comes in, to be able to help us to find out why is the profit figure different from the figure in respect of cash or bank balance on the face of the statement of financial position. And that investigation we are doing is where the preparation of the cash flow statement comes to play. It is important for you to understand that the profit or loss for the year, our focus is going to be the current profit or loss. Okay, so we are going to be focusing on the current year profit or loss. That's very important for us. Our focus is going to be on the current year profit or loss. But then the data from the statement of financial position will be coming from two angles. That is, we're going to be looking at the current year statement of financial position and the previous year statement of financial position. The current year statement of financial position and the previous year statement of financial position. I'm going to be explaining to you in a moment the reason for that. But that is basically the idea about the preparation of the cash flow statement. Reconciling the profit or loss for the year from the statement of profit or loss account with the statement of financial position, that is the cash or bank balance on the face of the statement of financial position. But the question we then ask ourselves is, how do we carry out this reconciliation? How do we reconcile the profit for the year? Really note that when we are looking at the profit or loss, we are dealing with the profit or loss before tax. So that is going to be the figure we are going to be starting our journey with. So the question is, how do we reconcile that figure with the balance sitting on the face of the statement of financial position? We do this by finding out or classifying the activities that the entity undertakes into three main categories. In other words, we're going to be preparing the we're going to be preparing the cash flow statement into three major activities. The first one is going to be the operating activities. So we're going to look at cash flow from operating activities. The simple thing that you need to understand in respect of cash flow from operating activities will be that we are looking at, in a simple terms, things that relates to the day-to-day running of the entity. So things that relates to the day-to-day running of the entity. That is the cash flow from operating activities. So anything that relates to the day-to-day activities of the entity will be covered under the cash flow from operating activities. But stay with me carefully, because we're going to be expanding on that in a moment. Number two is to look at the cash flow from investing activities. cash flow from investing activities. Now, the cash flow from investing activities in a simple language is going to be the issue in relation to acquisition and disposal of assets. Okay, so this takes into consideration the acquisition and disposal of assets. Now, when we talk about assets here, we mean assets. Okay, assets excluding, let me be specific on that, excluding, you know, current assets. I'm going to explain that to you, don't worry, because current assets relates to the day-to-day running of the organization. So the current asset implication will be dealt with under the operating activities. We're going to expand on that in a sec, don't worry. But that is the cash flow from investing activities. Cash flow from investing activities. Now, when we say acquisition and disposals of assets, what exactly are we talking about? We are talking about issues that relates to certainly property, plant, and equipment. We are talking about financial assets that an entity has acquired. We are talking about issues in relation to subsidiary. This is where corporate reporting students will come to town. Subsidiaries and associates. And we're going to expand on this in a sec. You're going to see the implication in a moment. So we're going to be talking about that as well in that particular case. So property, plant, and equipment, financial assets, subsidiaries, and associate, other forms of assets like investment property. All these will be under investing activities. So in a simple language, under investing activities, what we are looking at is, hey, which assets did we acquire during the year? Which asset did we dispose of during the year? That is the idea about the cash flow from investing activities. So day-to-day running of the organization, cash flow from operating activities. Things that relates to acquisition and disposal of assets, that is cash flow from investing activities. Then the last thing has to do with the cash flow from financing activity. Certainly, this is going to talk about the capital structure of the entity. So it considers the movement, or if you want, changes in the capital structure of the entity. What does that mean? It means that we're going to be bringing items such as equity. So movement in equity. Let me be specific. Stated capital. Movement in non-current liabilities. Movement in, let me put it this way, long-term debt. Very important in that particular case. When we say long-term debt here, certainly we mean interest-bearing debt. Because deferred tax is a non-current liability, but it's not part of long-term debt. It's not an interest-bearing debt. So movement in the stated capital is going to be coming. Movement in long-term debt is going to be coming in here in that particular case. And we're going to be expanding on all of these things in a moment. And then another thing that will be common also here may be issues about leases, okay? The capital element of lease payment. And I'm going to explain that to you as well in a moment as we get excited into the discussion. So this is how we're going to be preparing the cash flow statement. We want to, yes, reconcile the statement of profit or loss to the statement of financial position. How are we going to do that? We do that by categorizing the activities that the entity undertakes into operating activities, day-to-day running of the organization, investing activities, acquisition and disposal of assets, and then financing activities, the movement in the capital structure of the entity. But let's get excited and let's really find out how we can do this actually in practice. So I'm going to have my pro forma put up here. And we're going to have the statement of cash flow. For the year ended, whatever the heck we are doing. Then we will always start with the first item we spoke about, which is what? Cash flow from operating activities. Operating activities. That's where we're going to start. And we will tell the examiner we like to work probably 2 cash columns in that particular case. Then, if you remember again, what did I say? We're going to be starting with the profit or loss before tax. So we go to the current year. Again, remember we said in the statement of profit or loss, we are dealing with the current year statement of profit or loss. So we go to the current year statement of profit or loss, and we're going to pick the figure that is there. So profit or loss before tax. Now, if it is a profit, certainly that's going to be a positive figure. If it is a loss, certainly that is going to be a negative figure. Whatever it is, we're going to bring it. Okay? We're going to bring it. Give me a sec. Let's see if we can pull that down a little bit. All right. So that is our first line item. Now, let me say this before I get excited. There are 2 ways that we can prepare the cash flow statement by default, but really the operating activities. We have what we call the direct method and then the indirect method. Now, we are not going to be using the direct method. Nobody uses the direct method. So whatever we are going to be doing here is simply the indirect method. And if you see the cash flow statements of any financial institution, any company around the world, it is going to be the indirect method, which is what we are going to be presenting. The direct method is simply where we are bringing in the real items like, okay, how much did we pay our suppliers? How much wages and salaries did we pay? How much did we receive from our customers at the end of the day? That is the direct method. We are not going to be using that, but we are going to be going with the indirect method. So if you see a question somewhere and the examiner says, oh, prepare the cash flow statement for the entity for the year ended, whatever the heck, using the indirect method, it's not anything new. It's just what we are supposed to do that we are doing. That's all. So I want to really clear that, bring that distinction before we get excited into our discussion. So we don't need a miracle for that first item. So we just go to the current year profit or loss account and pick it up and bring it in directly. Now, once we get our profit or loss and bring that line item up, we then begin to do various adjustments. And this is where the journey begins. The first thing we're going to be bringing is to adjust for non-cash items. So I'm going to have my workings flow here for us to go through. So this is my workings flow. And I'm going to have the workings flow for both financial reporting students. Then I'll have another working flow to bring in what corporate reporting exclusive you must know about. Does that make sense? So this slide is not for financial reporting students, but everything here is for the 2 of you. Okay. So what do we do when we are doing the cash flow? So, step number 1 is what I wrote there. We're going to make first adjustment for non-cash items. Remember that the profit or loss account, it's going to be having a lot of non-cash items. So we need to adjust for it. Like what? You know that already. Depreciation is a non-cash item. Amortization is a non-cash item. Impairment of assets is a non-cash item. So in the question, you may have to calculate some of these things. Other times they will be given to you directly. I'll come back to it. You're going to see it. Now, these were expenses. So they reduce the profit. So if we are adjusting it and it's a non-cash item, we want to bring the profit back to its original item, because the cash flow statement is looking at the actual cash that went out and the cash that came into the business. So depreciation is a non-cash item. It reduced our profit. So what do? We add it back. So impairment, amortization, depreciation is going to be added back. Like I said, sometimes you have to calculate these on your own. Other times the workflow will be given, and I'm going to be getting into that in a moment. So that is the first non-cash item that we deal with. Another thing, this is exclusively for corporate reporting students, will be what we will refer to as impairment in goodwill. Again, like I said, for corporate reporting students, we can be asked to prepare the consolidated cash flow statement. And so in that case, you would have to do the workings for the goodwill account so that you can get the impairment in goodwill. Remember, impairment in goodwill will be added to either the cost of sales or brought on the face of the P&L account. So it will reduce the profit for the year. So we have to come and what? Add it back. It's an impairment. But you have to work for that. And that is where our corporate reporting exclusive comes in. Workings 1, we have to prepare the goodwill account. So the way we prepare the goodwill account, it's an asset. So you bring in the opening balance, which is going to be last year's figure. You're going to pretend to close it so that you get a closing balance, which is the last year's figure. Then if during the year the entity made any acquisition and goodwill came out of it, we are going to be adding it there. So acquisition during the year, any goodwill that came may come in there. Then the balancing figure, it's going to be on the credit side. And that will be the impairment in goodwill. So you're going to be working this in out. Now, this particular workings, goodwill arising from the business that we acquired during the year, we would have to work for that as well. And we'll explain that tomorrow when we are doing consolidated financial statement. But for now, that is how we prepare the goodwill account. Now, if you finish and the debit side is the same as the credit side, it means that there is no impairment in goodwill. But this is a pro forma, so we're going to explain all the principles generally at the end of the day. So depreciation, amortization, impairment of assets in accordance with IAS 36, it's added back. Then for corporate reporting exclusive, impairment in goodwill will also be written off in the consolidated profit or loss. So we have to come and add it back to the profit of the entity. But that is not all. You know about fair value gain or losses, like financial assets carried at carried through at fair value through P&L. Those fair value gain or losses were adjusted for in arriving at the profit or loss for the year. So, and these are non-cash items as well, so we have to adjust for them. So fair value gain or loss. If it's a gain, we're going to subtract it. If it is a loss, we're going to add it. Let me explain. So, and we've solved questions about this over and over again, so you know the implication of what the heck I'm talking about. So we have a financial asset carried at fair value through P&L. And during the year, the opening balance was 2,000, okay? And then the closing balance became 2,800. That means there is a fair value gain of what? 800. This fair value gain of 800 will be added in the P&L account. That's a non-cash item. So when we are preparing the cash flow statement, we have to reverse that. So the gain was added. It increased our profit. So what do? That's why we subtract the gain. If it was a loss, it will be expense. It will be deducted in arriving at a profit or loss before tax for the year. So what do? We add it back. So it depends on what is happening. But that is also a non-cash item that we're going to be adjusting for the period under review. Next one. If it happens that the entity revalued assets and a portion of the revaluation loss had to be charged in the P&L account. Again, you know this from the accounting standards already. Remember, cash flow statement is just the accounting standards we are doing. So we are applying the principles from the accounting standards. And you know in IAS 16 or IAS 38 that when we revalue assets and it results into a revaluation loss for the first time, that revaluation loss is brought into the P&L account. If we revalue the asset and it results into a revaluation loss, but previous year there was a gain on it, that loss will be written off against the gain, and then any excess is what will be brought in the P&L account. The opposite of that is with revaluation gain. If there is revaluation gain for the first time, it goes to the OCI, other comprehensive income, no P. But if we have a revaluation gain and the previous year the asset was revalued and it had a revaluation loss, then a portion of that gain will be recognized in the P&L account equivalent to the last year's revaluation loss. Then the excess gain is what is recognized in the OCI. We've done this already. We are just applying. So revaluation gain was added, so we're going to subtract it. Revaluation loss was subtracted, so we go and add it back. Again, that is not a cash item, so we adjust for it. So it depends on the context of the question, but you are seeing that the accounting standards are just playing out in the presentation. Yes, Ernestina.
Hello, sir.
Yes.
Sir, please, can you take the fair value gain or loss again, please?
We mentioned that if we are carrying a financial asset at fair value through P&L, and the opening balance was 2,000, the closing balance is 2,800, that is fair value gain of 800. That is recognized in the profit or loss. We've solved questions in respect of this treatment. So if that gain was added to the profit or loss in arriving at the profit or loss for the year, then when we are adjusting for it, that gain will be subtracted. If it was a loss, then it was treated as an expenses. So because it's a non-cash item, we come and add it back to the profit before tax for the year. That's the issue. Does that make sense? Okay. So depreciation, impairment in goodwill, fair value gain or loss, revaluation gain or loss. Again, if you have problem or you get any problem with cash flow statement, it is not because you don't know the pro forma. It's because you are not strong in the accounting standards, period. Because cash flow is not about pro forma. It's about the accounting standards and how you are applying the accounting standards. And you are seeing them playing out here. IAS 16, IAS 38, IAS 36, IFRS 9. All of these things playing out here. IFRS 3, business combination, all of this playing out here. So it's about the accounting standards, not anything exclusive. Now, so the trick is that you must know what was done in the profit or loss account, and you are reversing that in the cash flow statement when you are doing the adjustment for step one, non-cash items. So what they did in P&L accounts, you are reversing that in the cash flow statement so that you bring it to the real position that it has to be. Yes, Nathan.
Yes, sir. Please, I want you to throw more light on the revaluation gain aspect. For me, I was thinking that it's only the revaluation loss that will appear in the statement of profit or loss. But here I'm still seeing revaluation gain also. Because I know that when you have the loss, that's why for the first time you take it to the statement of profit or loss. Then later on, if you have any gain, then you need to remove that loss that you charge first in the profit or loss account before you take the remaining one, if any, to the OCI. So I don't know why the OCI item, which is revaluation gain, is appearing here.
So
So I want you to.
what are you saying
What are
right
you
now?
saying right now?
You are saying
You
that
are
if
saying that.
subsequently we had a gain and then now we are having a loss, then sorry, subsequently we had a loss and now we are having a gain. You just said that the gain will be written off in the P&L account equivalent to the loss that we recognized last year. That's what you are reversing in the P&L account
Ah,
as well. So,
eesh. Okay, okay, okay. I got it now. I
right.
got it now.
So, depreciation, amortization, impairment, then impairment in goodwill, corporate reporting students, exclusive for that. Then fair value gain or loss in accordance with whatever the heck, IFRS 9. Revaluation issues in accordance with, you know, IAS 16 or whatever the heck accounting standard we're going to be applying in that particular case. So that is the first thing we do, some non-cash item. Now, the other thing is then after you deal with those non-cash items, the second step is to reverse some items that were brought in the P&L account which are not supposed to be in the P&L account for now. Stay with me. I'm going to explain it. I'm just trying to uh, be a little bit some way, but stay with me. So we're going to reverse transactions that are not to be in the P&L apart from the step one. Stay with me carefully. So after we deal with this non-cash item, the next thing we want to talk about is the interest finance cost. The finance cost charged for the year in the profit or loss account is what we charged for the year. That may not be what we paid for the year. Because remember the figure we are picking. We are picking profit before tax, meaning we have deducted the finance cost already. So the finance cost charged for the year in the profit or loss account may not be the same finance cost that we paid during the year. For that reason, that finance cost, we have to reverse it and deduct it. Sorry, add it back. It was an expenses. So we add it back to the profit. Then stay with me. Government grant charge for the year. Government grant charged for the year is something that is supposed to not that is not supposed to be part of the P&L account because you receive government grants as a result of making investment decisions. But in accordance with IAS 20 government grant, the entity can use the deferred income approach to account for government grants, meaning that we treat the government grant as what? A deferred income, and amortize it each year. So the amount that is amortized for the year will be added to the profit. Now, we're going to subtract it. Then the actual government grant that we received during the year, like I said, government grant is issued or is received usually due to investment decision. So that will come under cash flow from investing decision. Or investing activities, sorry. So under cash flow from investing activities, the actual government grant that we received, the total money, again, not government grants we qualified for, but the government grants that we actually received during the year will come here as an inflow. The charge for the year will be subtracted from the profit because it was added in arriving at the profit or loss for the year. So we are going to subtract it back. Yes, Ernestina.
Isha, I thought the first item was profit or loss before tax, which means finance cost is already in there. So why finance cost again here?
I don't
Isha,
understand what
today
you are
you're
saying.
moving at a faster rate.
I don't understand what you are saying. Can you ask your question again?
I said cash flow from operating activity. The first item is profit or loss before tax, meaning finance cost has been taken already to arrive at that. But then there's finance cost here again. Is it because we've taken it
No,
out
no.
from?
Relax, relax. What we are saying is that, yes, what you are saying is correct. In arriving at the profit before tax, we subtract finance cost from there. But what we are saying is that the finance cost charge in the profit or loss account may not be the same finance cost that we paid during the year.
Okay.
For that reason, since it was deducted in arriving at that figure we are starting with, we are going to be adding it back.
But if it's what we paid for, it's not going to
Don't
come.
worry, don't worry. We'll talk about that later on because we will talk about the actual interest cost that we pay during the year in a moment, and you're going to see how that one also plays out. So just flow with me the way I'm flowing.
Okay, Bansha, today from my end, you're moving very fast too.
Really? Okay, oh, I'll try and see if pick. I don't know. I'll try and see if I'm moving fast or slow. All right, so government's grant charge for the year, like I said, the actual government's grant that we received for the year is going to be brought under the investing activities. The actual government's grant we received for the year. But in accordance with IAS 20, government's grant is going to be recognized by default as a deferred income. And for that reason, we are going to be charging an amount for the year. That amount we charged for the year increased our profit, was added in arriving at the profit or loss for the year. So what are we going to do? We're going to deduct it. So we adjust for the finance cost, we adjust for the government's grant as well in that particular case. Then the next item is for corporate reporting students exclusive. Profit or loss. Sorry, let me put it this way. Share of profit or loss from investment in associate. This is for corporate reporting students when we are preparing consolidated cash flow. So The first item for corporate reporting student was the impairment in goodwill. The second item exclusive for corporate reporting student is this one. So FR student, don't think about it. You won't get it. Stay with me again. In accordance with IAS 28, investment in associate, our share of profit or loss from the investment in associate must be brought on the face of the consolidated statement of profit or loss. But share of profit or loss is not money we got. Does that make sense? So it also must be adjusted for. If we got profit per the question, then it was added, so we'll subtract it. If it was a loss, then it was deducted. So what do? We add it back. So profit is going to be deducted, a loss is going to be added back. Again, all we are looking at is knowing what has been done in the profit or loss account based on the application of the accounting standards. Then you rewrite that. Now, the actual dividends that we received from the associate or that we received from our subsidiary is because of investment. So again, that is to corporate reporting students exclusive, that will come under cash flow from investing activity. So dividend received. It could be dividend received from other forms of investment we make. It could be dividend we are receiving from our investment in associate. It could be dividend we are receiving from our subsidiary. It's an inflow, the actual dividend we got. Okay, it's an inflow. The first item, dividend from investments, that one is for CR students as well, because if the entity has any normal investment and they are receiving any dividend or interest income, it's going to be coming here. So dividend received or interest income. So maybe they have some investments and they receive some interest. The actual interest for the year is going to be brought here because they are inflows coming in from our investments. So share of profit or loss from investment in associate. If it was a profit, they added it. So we come and subtract. If it was a loss the associate made and we got our share of it, then we subtracted it in the consolidated profit or loss in arriving at the profit or loss before tax. So what do? We come and add it back. We add it back. So these are some other things that we are going to be adjusting for in step 2. So step 1, primary non-cash item. Step 2, we reverse some other items apart from the things we mentioned in step 1. And so that is where we are bringing up the finance cost. That's where we are bringing up government grants. That's where we are bringing up share of profit or loss from the associate. Now, there could be some other items lingering in the question. The take is always like that. Know the accounting standard, know what they had done in the P&L accounts, and find out how the heck can I reverse that. That is the idea about that. Now, once we get this, we're going to be adding the arithmetics up. Then we could have a positive figure or a negative figure. Okay? Then we move to step 3, which is to bring in the movement in working capital. the movement in working capital? It's very simple. You know the elements of working capital already: inventory, trade receivables, other forms of current assets apart from cash and bank. Then the liabilities, you know them already: trade payables and all of those things. So the movement in working capital you are bringing here are all working capital except cash, bank, and current tax. Please be careful. These are items which form part of the working capital of the company, but we're going to deal with them exclusively later. So when we are talking about movement in working capital, we are talking about all the items under current assets except cash or bank. All the items under current liabilities except current tax. Why do you have to know that? It's simple. Because our next line of action to deal with the movement in working capital, we are going to say that increase in current assets. Let me put it this way. Let's do the two together. Increase slash decrease in current assets. If it's an increase, money is going out. If it's a decrease, money is coming in. Let me explain what we are saying. This is what we are saying. Another one element of current asset is inventory. So we have 20x5, 20x6. So inventory. Last year, 20x5, our inventory was 10,000. This year, 20x6, our inventory is 40,000. What does that mean? It means that the inventory has what? Increased. How did it increase? It means that cash is going out of the business. It means we are buying more what? Inventory. That is why increase in the inventory will become an outflow. But if it was the reversed, then it will be an inflow. So for instance, we have trade receivables, people who owe us. Last year, at the end of the year, we had 35,000 people owe $35,000 in terms of trade receivables, which is a current asset. But at the end of this year, our trade receivable figure is just 15,000. What has happened? Our trade receivable has reduced. Reduction in trade receivable means what? It means our customers are paying us. If customers are paying us how much they owe us, what does that mean in principle? It means money is coming into the business. That is why we say increase in current assets means money is going out. Decrease in current asset means money is what's coming in. That is the idea about this principle here. That's the idea about this principle. The reverse is true for liabilities. So, again, increase, decrease in current liabilities. Again, like I said, all current liabilities except current tax in the principle here. So we are dealing with trade payables. We are dealing with expenses owings. We are dealing with some other forms of provisions that we have under current liabilities. Yes, Clement.
Please, Isha. The increase in current asset, is it under the operating activities or
Yes, we are
the
still on
invest?
operating activity. We have not. We are still in operating activity.
Okay, all right. Thank you.
Okay. So, current liabilities. Now, if your current liabilities are going up, what does that mean? It means you're not paying the people you owe in the short term. And if you're a good finance student, one of the sources of finance to business in the short term is trade payables. So if our trade payables is going up, it means we are not paying our suppliers. So money is coming in. But if our current liability is reducing, it means we are paying them. Hence, an increase in current liability means money is coming into the business, that is an inflow. A decrease in current liability means money is going out of the business, and so that is an outflow. So again, let's bring an illustration here. If we have whatever the heck, 20x6, 20x7, then we have whatever payables, trade payables. Okay, trade payables. All right. Last year it was 40,000. This year it's 60,000. What does that mean? It's gone up. Where is the money? We are using it to run other aspects of the business. So that increase means we are saving that money, we are conserving that money, and hence it's an inflow for us as a company. It's an inflow for us as a company. That is the idea about movement in working capital. But, so this is the default. But corporate reporting students, we are going to have a little bit icing on the cake. So let's go to corporate reporting exclusive workflow, and let me show you how the working capital workflow will look like. So you're going to do a workings for that. That's movement in working capital. Financial reporting student, you don't need this because you can do it directly on the face of the financial statement by deducting the last year figure from the current year figure, and then you get your movement. All right, so you don't need to do this workings, but corporate reporting students, you might need this workings. So what do we have? We're going to be bringing the individual items, so probably inventory, what the heck, trade receivables, and maybe trade payables, who knows. So we slash in our currency sign. Then you bring in the opening balances, which is last year's figure, respectively. Please stay with me carefully. Remember I told you that when we are preparing the consolidated cash flow statement, it's likely that during the year we acquired a subsidiary. Now, when you acquire a subsidiary and you gain control of it, their assets and their liabilities belong to you. So if during the year the entity made any acquisition of a subsidiary and obtained control over them, then their trade receivables will be added to ours. Their inventory will be added to ours. Their trade payables will be added to ours. So we bring in the subsidiaries issues and add them. Give me a sec. Let's see if I can throw it to the next slide or in the next slide. Oh, what am I catching? Okay. Okay, so you bring the subsidiaries inventory, subsidiaries trade receivables, subsidiaries trade payables here. Then there could be some foreign exchange issues because of the movement. And that could be either a positive or a negative. You're going to be bringing that up in accordance with IAS 21, because goods may be sold or bought and translation may happen. So whatever be the case, you do workings for that. Gonna get your net figure, get your net figure, get your net figure. You compare that with a closing balance on the face of the consolidated statement of financial position. The balancing figure will give you your increase or decrease, which you would take to the profit or loss, consolidated cash flow statement here. Does that make sense? So for corporate reporting students, you will be doing this workings. If during the year in the question, the entity happens to acquire a subsidiary and obtain control. So if they acquire a subsidiary and they obtain control, then you need to bring their inventory. You need to bring their receivables. You need to bring their payables. Now, how do you know it is increase or decrease? You just compare what is expected to have as against the closing figure, and then boom, you make the decision. So if, for instance, is the inventory, and based on the expectation, when you added the subsidiaries figure, you expect inventory of 10,000. But now closing, the inventory is just 8,200. That means the inventory has reduced, right? A reduction in inventory means we have sold. So that is going to be a cash inflow for us in that particular case. Why? Because we said decrease in current asset means cash is coming into the business. So that is the flow for corporate reporting students in the preparation of the consolidated cash flow statement. Like I said, financial reporting students, you don't need this. You can just do it on the face of the financial statements like that, and you'll be okay. Okay. So once we get these movement in working capital coming in, we can now bring in, we will get a figure and we can call that maybe cash generated from operations. Okay. Cash generated from operations. And that could be a positive figure or a negative figure. We are not done. We are left with 2 items to go. And my space is exhausted, so I'm going to move to the next slide and continue. All right. So the next item that will come, still under the operating activities. Now we've done the issues that has to be done. So 2 items will be, number 1, the interest that we paid during the year. We may do workings for that or not. So this is where the question that the Nextina asked will come to play. How do we know if we have to do workings for this or we don't have to do workings for this? It's simple. You go to the statement of financial position. Under current liability, if there is interest under current liabilities, then you would have to prepare the current liabilities account. Where's my FR workings flow? What the heck? Okay, yeah. So interest expenses, got to prepare the interest account. So you do this workings. If under the current liability, there is interest owings. If under the current liabilities, there is interest owings. And you know interest owings keeps a credit balance. So you bring in balance brought forward here. Pretend to close the account. Then we get a balance brought down. Then we bring in the finance cost charge for the year. And you're going to pick that usually from the P&L account. Then you can now close this account, and the balancing figure is the interest paid. Sounds good? The balancing figure is the interest paid. So we would do this workings if on the face of the statement of financial position under current liability there is interest owings. But if on the face of the statement of financial position there is nothing about interest under current liabilities, then the interest that was charged for the year will be the same as the interest paid for the year. Sorry. So this is where earnestiness, your point will then come in. So it means that the same figure we deducted above, we added here. Okay, the same figure we added here, right? That's the same figure will come and what? Subtract here. Because in that case, we will assume that the interest paid for the year is the same as the interest charged for the year. Because on the face of the statement of financial position, there is no interest owings. So how do we know we have to prepare the interest account? Go to the statement of financial position under current liability and find out, is there interest expenses there? Is there interest owings there? If there is interest owings there, you prepare the interest account and bring the opening balance, bring the closing balance, then you bring the charge for the year, which you will find in the P&L account. Then you balance it up. The balancing figure will be on the debit side. On the debit side. It means that is the interest that we have paid during the year. But if you go to the statement of financial position and there is no interest owings under current liabilities, it means the interest that was charged for the year in the P&L account is the same interest that we paid for the year. And that's a common sense. So the amount that we added back above here when we're doing our adjustments will be the same amount we will bring here and deduct it. That's the idea about that. Then the next item is going to be the income tax paid. That you're going to do the workings for it, whether you like it or not. So let's look at the workflow for that as well. The tax paid. Now, I want you to stay with me carefully here because it's an interesting area and you need to understand the IAS 12 preamble well. So again, if you have a problem with IAS 12, you're going to screw this up. So that is why I keep on telling you, everything we are doing here is just application of the accounting standards. So if you have problem with cash flow, it's not because cash flow is difficult, it's because the foundations are weak. So income tax account, we're going to rope in everything, but you got to be mindful of what the heck is going on here. So we're going to bring in the opening balance. Usually you expect that the income tax will have a credit balance. In other words, you're going to pick the amounts under current liabilities and non-current liabilities. Because in current liabilities, you will get your current tax. Under non-current liabilities, you get your deferred tax. Usually. Then you pretend to close the account, and the closing balances also, usually, again, you expect them to be under current liabilities and non-current liabilities. So current tax, deferred tax. Then You go to the financial statement and look at the charge for the year. But stay with me here carefully. Again, your knowledge of IAS 12 is crucial here. If you remember, income tax charge for the year can be both in the P&L account and in the OCI. Because when we're doing income tax and we're doing deferred taxes, we said we can have deferred tax liability in the OCI. So when we say the charge for the year, you're going to go in both the P&L account and the other comprehensive income. If there is a charge for the year in the P&L account, you bring it. If there's charge for the year in the OCI, you bring it. Negative, negative, you bring them here. You balance the account up. The balancing figure will be on the debit side. And that is the tax paid. Again, IAS 12 is in town. IAS 12 is flexing around. You got to understand it very well. It's not a miracle. You got to understand it very well. But you see, sometimes the examiner is not going to be a Father Christmas and bring you the default treatment. So your brain has to work very well. And if you listen to me carefully, I said something. If you were you were listening attentively, I said something that this charge for the year, if it was deducted in the P&L and in the OCI, then you bring it on the credit side. The reason I was emphatic on that, and I'm bringing your mind on it again in case you missed it, is because sometimes in the profit or loss account, the income tax figure could be positive, not negative. It could be a positive figure. What does that mean? It means that the entity is having some tax relief. Hence, it wouldn't be on the credit side. It will instead be on the debit side of this account. Like I said, it's about application of the standards. So you have to be careful. So alternatively, we could have this whole account prepared in another way. So sometimes the opening figures may not be on the credit side, they may be on the debit side. So balance brought forward. If it's on the debit side, fine. Probably that could mean the entity is having deferred tax asset, because deferred tax assets will be under non-current asset. Deferred tax liability will be under non-current liability. You know this already from IAS 12. It's not something new. So that Nhyira is teaching anything new. You know already. I'm just crystallizing, if I can say that. So sometimes it could have a debit balance, and we could also have the current tax being on the credit side. We'll pretend to close, and sometimes we could have a credit balance here and then a debit balance here. The reason I'm emphasizing again on this is that, you see, like I say always jokingly, some of you, your brain operates linear. In other words, we want to plot a straight line. So one dot here, we connect. That's how your brain works. But immediately you are given something that will require you to draw a scatter diagram, where you are not doing linear programming, but you are sketching a scatter diagram, and you have to then plot, so that you will join like this, like this, like this, Your brain doesn't accustom itself to that. So that is why I'm emphasizing on this, that I want you to have that holistic understanding of the standards. Yes, this is the default pro forma, but that doesn't mean this is what you would do always. Because if the income tax figure charged for the year is positive, you don't bring it on the credit side of this account. You rather bring it on the debit side. So your charged for the year could be on the debit side. Again, it's a pro forma that I'm teaching. So I'm going to make sure that I bring to light every possible thing, which you are supposed to know already, but I have to revisit. At the end of the day, you will still balance, and the balancing figure will give you the income tax paid for the year. Give me a sec. Let's see if I can bring these guys down a little bit. Down a little bit. Take this out. Get my balancing figure still coming here, and that'll be the income tax paid. That is the idea here. So it's not anything new we are doing. It's IAS 12. But you must know what should be on the credit side, what should be on the debit side, when something is supposed to be added, when something is supposed to be subtracted. Yes, Abigail.
So please, could you please take the income tax treatment again, the explanation for the income tax treatment?
Which, like, you mean I should take
The
the
one
whole
you
thing
said,
again?
yes, please. The one you said, I think you said we should debit it in.
I don't understand your question. Oh.
You said that it's not always the case that the income tax will be at the credit side. There are times that it will come to the debit side. If I
Yeah,
heard you clearly. Yes,
yes.
please. So could you please take that explanation again? My
So
network
we are
wasn't too
saying
steady.
that in the profit or loss account, the tax for the year, the income tax charge for the year, by default, we know it to be to be negative, which means we are deducting it in arriving at the profit for the year. If it is negative like that in the profit or loss account, no problem. You bring it on the credit side of your income tax account. That is the default treatment. But I'm saying that there are times when that income tax in the profit or loss account is a positive figure, not a negative figure. So if it is a positive figure and not a negative, that could be a tax relief that the entity is having. So if it is a positive figure, then you cannot bring it on the credit side of your income tax account. Instead, it is going to be on the debit side of the income tax account. This is what we are talking about. So it is about what is being done in the P&L account. If it is negative, bring it to the credit side of your income tax account. If it is positive, it means it must come on the debit side of the income tax account. All right, give me a sec. Let me plug my device. Okay. Yes, Evelyn. Yes, Evelyn.
Nhyira, please. I seem not to be grasping the second treatment, so the alternative one. I'm still saying stars.
What don't you understand? And what's the problem?
I think you brought the current tax balance, treated it as the default one, but the charge going to the charge for the year going to the debit side, I'm not getting the explanation well. It means that the balance brought forward on the debit side, is it for the deferred tax or the current tax? Because I'm seeing balance brought forward on both sides.
It doesn't matter which balance it is. It's a pro forma, so we must understand where it is. We have said that the deferred tax can be a deferred tax asset or deferred tax liability. If it is a deferred tax asset, then it will be under non-current liability. That has a debit balance, so we have to bring it on the debit side. But our current tax may still be under current liabilities, hence that will be on the credit side. Then number two, we are saying that the income tax figure in the profit or loss account is positive, and that will be like a tax relief. That means we are not paying taxes. That means our tax liabilities have reduced, and it's an asset. So that is why we will bring it to the debit side of the income tax account. So it is the reverse of if it is negative. If it is negative, we bring it on the credit side because it increases our tax liability. That is why we bring it on the credit side. But if it is a positive figure, that means we are getting a tax relief, and that reduces our tax liability for the year. Anything that reduces our tax liability for the year, it's an asset, and that becomes a debit balance. That is why we will bring the charge for the year when it's a positive figure in the P&L account under or on the debit side. Yes, Evelyn.
Sure, please. If it is a positive figure and it's like an income reducing our tax liability, do we have to give the description as charge for the year? Because it's like, then is it going to be it's a positive figure? So do we have to still describe it as charge for the year?
Where are you picking it from? We are picking it from the profit or loss account, and that is the income tax figure for the year. So, charge for the year. Charge for the year does not mean it's an expenses. Charge for the year can be an income. If you remember, in the operating
That's
activities,
what was confusing me.
the government grant, we brought charge for the year in the government grant.
Mm,
So charge
okay.
for the year doesn't mean it's an expenses. It simply means what was taken to the P&L account.
Okay, so that was what we were supposed to like have paid, but it's a relief for us. That's
Yeah,
why
it's a
it's
relief, so we don't pay that. So it's going to
okay
come to the
now.
debit side of the income tax account.
Okay, as an income. Okay, okay.
Cool. Yes, Bukari. Yes, Bukari.
Hello, Nhyira.
Yeah.
Yeah, in note 3, you said that movement in working capital, all working capital except cash or bank and current tax. So why are we doing bringing current tax here? Like we are doing adjustment to the current tax.
I don't understand your question. I don't
You,
understand the reference
you
you are
said
making and the question you're asking. Yeah.
like when the movement. in working capital, that's what we will do we will do it. The movement, whether increase or decrease, then we bring the changes there. But you went further and said that except bank and cash and current tax. So why are we bringing current tax in the workings?
Relax.
Just want to say.
I don't understand what you are saying here. What we are doing has nothing to do with working capital. That is why I said except. Except means that item is not part of working capital. So if you're asking why are we doing the workings, I don't get it. Because we said except, it means it's not part of working capital. So we have to work it separately. And that is what we are working here. So I don't understand the reference and why you are saying, because the word except means excluding. Without that, that is not part of it. So if that is not part of it, then we have to do workings for it separately. So what the income tax we are calculating here and the interest expenses are not part of working capital movement. We have already finished with that. These are separate items that we are working for.
Okay. I get it.
Okay. All right. So that is our tax environment in that case as well. Again, application of IAS 12, the standards. So it goes back to what I keep on telling you. If you are weak in the standards, cash flow will be a nightmare for you. And so sometimes people are like, oh, cash flow is difficult. And as we are teaching like this, I know some of you, you've written it off in your head. We don't care. If you like, throw it in the garbage. If you like, pray it doesn't come. If you like, sow seed about it. Whatever the examiner wants is what he will bring. Your responsibility will be understanding the accounting standards and understanding the principles that we are explaining well. Because if you realize we are not doing anything new here, nothing. We are not doing anything new here. All we are doing is applying the accounting standards, stating the principle, looking at what has been done and rewriting it for cash purposes. For cash purposes. That's all we are trying to do. That's all we are doing. Okay. Now, dividend paid can sometimes be brought under operating activities or in the financing activities. In my pro forma presentation, the way my brain works, I want to bring it under financing activities. Are you okay? So we will end here, and that is all. That gives us the net cash flows from operating activities. That's it. We're done with the operating activities. And it is one of the areas that will really cost you some marks when it comes to dealing with cash flow statements. It's one of the areas that will cost you some marks. So that is our cash flow from operating activities. That's all. Okay. So in my principle, can then write step 4 because I should have written that. Calculate the interest. The interest paid and income tax paid for the year. So that's the fourth thing which we just did here. The interest paid and then the tax paid. Again, remember the rationales, remember the principles that we explained and talked about. Okay. So let's go to the investing activities and wrap it up. We've already said government grants that we received during the year, the whole amount we got during the year will be brought. 2, we said the dividend that we received during the year will be brought here. Now, there was one thing I don't think I mentioned it, but I could put it in my slide because I have luxury of space here. So give me a sec. Let me push it into my slide. Investment income. Normally it will be charged to the P&L account, but that is not part of our day-to-day activity, so it will be deducted. So that investment income, we subtract it from the operating activities and add it in the investing activities. Does that make sense? Because it's not, we are not into investment. Okay, we are not into investment. So if we got any income from our investment in the preparation of the profit or loss account, we recognize it in the profit or loss account as part of other income. But that is not part of our day-to-day activities. Again, remember we said operating activities has to do with the day-to-day running of the organization. So since that investment income, yes, it's a receipt though, but it's not part of our daily activities, we subtract it in the operating activities, then we bring it under investing activities. Okay? Next one. Proceeds from the disposal of assets. The proceeds from the disposal of assets. Now, again, corporate reporting students, if we sold an investment in associate, or a subsidiary, that will also come here. All of that will come here. So all assets that have been sold will be brought here. It's an inflow. Okay? Then acquisitions will come. So acquisition of assets. Again, this will be the cash consideration. Corporate reporting students again. Cash consideration to acquire a subsidiary or investment in associate. Sounds good? So that what is in the bracket is for corporate reporting students. If during the year we acquired a subsidiary, the cash we paid them will come here as a deduction. If during the year we made an investment in associates, the cash we paid them will be an outflow. But then all other forms of assets like property, plant, and equipment, like investment property, like financial assets that we that we buy, all those will be an outflow as well here. That is why I'm using the word asset. But really, we are not talking about current assets. We are talking about non-current assets. So let me even clarify that very well. Because, again, some of you, your brain, the way it works, we have to make sure that it's in line with the brain analogy. Yes, Nathan.
Yes, I want to ask a question about the investment income. What I know is that the investment income, when we are looking at IS 32, that presentation of financial instruments, sometimes the investment income that we carry to the statement of profit or loss might is not the one that we actually receive. So in this case, which one are we going to put under the investment income under the investing activities? Is it the one from the statement of P or L?
Again, I keep on saying this, and stay with me carefully. We said the cash flow is about cash items. So if in the profit or loss account you brought in the effective rate, which is what you charge in the P&L account, then that was not what you received, but you deduct it because it's not supposed to come. So
Yeah.
what we are bringing here is what you charged in the P&L account. That is why we said what you brought in the P&L account. In the investing activity, we are saying the actual investment income you received, the cash item.
Okay. You didn't
So
mention that. That's what I'm
no,
asking.
no, no. We are dealing with cash payment and cash receipt, and I made a reference to that. So that's why your question came at, like, I don't know. Are you listening to me well? I don't know. That's the kind of thing. So
Speak
your
to me.
question is valid. The effective rate is what will come to the P&L account. So that is what you are deducting here. Under investing activity, the actual investment income that you received. That is why I wrote here interest received. The actual money you received, that's what you are bringing here. So yes, the figures may be different, but it is what you actually receive. That's what you are bringing under the investing activities.
Okay. Thank you.
Okay. Then so government grant that we received, emphasis. Interest income that we received, emphasis. Proceeds from the disposal of assets. Again, let me just say non-current assets, because again, I always say your brain, some of you, your brain needs deliverance to be able to understand things. And I say that, just on a low key. Then acquisition of non-current assets. Like I said, corporate reporting students, cash consideration to acquire a subsidiary, cash consideration to acquire investment in associate. L'argent, les pas, les poe is going out. So we deduct it. So anything at all that relates to investment will come under investing activities. Cash we got and cash we paid. All right? So these are some of the things that we will get here. And then we will get the net cash flows. That could be a positive answer or a negative answer. And that will be the net cash flows from investing activities. Okay, the net cash flow from investing activities. Okay, so you realize that in the investing activities, there's no much miracle going on there. It's like, everything is well. Let's look at the last one. Cash flow from financing activity. Cash flow from financing activities. Very important. Like we said, what did we say? Financing activity is about what? Movement in your capital structure. Okay, so what the heck? Proceeds, cash proceeds from the issue of shares will come here. It's an inflow. Now, I use the word cash proceeds on purpose because there is bonus issue. So your share capital may go up. That may not mean all the difference will come here. Let me say that again. The share capital may increase. That may not mean money came into the business. That is why I'm saying it is cash proceeds. So if there was any bonus issue during the year, au revoir, mesue, it doesn't come here. We didn't get any money, so we don't bring bonus issue here, because bonus issue is the issue of free shares to existing shareholders. We are just converting some reserves into share capital. So the concept here is cash proceeds. Rarely are we going to have this, but repurchases of shares, it's an outflow. So if the share capital is going up, the only is going down, the only reason that could be is because of the fact that the entity is repurchasing some of its shares. Now be careful for corporate reporting students. From financial reorganization and corporate restructuring that a share capital can reduce. And that is not because we are repurchasing shares, but because we are doing debt to equity swaps. We don't expect the examiner to go that extreme, but get a concept. Get a concept. Then, proceeds from the issue of loan notes. That's an inflow. Repayment of loan notes. That's an outflow. Yes. What do I have? Yes, Clement.
Nhyira Premium, is it repurchases of shares? I think you've written of shares of shares.
Oh, repurchases of, okay, shares. Equity shares. Okay. Then dividend paid. Like I told you, sometime it could be under what? Operating activities. If you are excited, you bring it there, you are okay. In that case, don't bring it here. Does that make sense? So the dividend paid can be under operating activities. It can also be under financing activity. The reason why it will be under operating activity is because, yes, as part of the day-to-day running of the organization, shareholders must be rewarded. So we have to pay them dividend, isn't it? So that's why it will be under operating activities. But the second school of thought is dividend is coming in because of the shares that we have issued to the shareholders, and hence financing activity. So you just choose which segment you want to bring it, and you'll be okay in that case. But you have to do a workings for that sometimes. So let's go back to our workings flow and get some workings coming in here. By default, you're going to use your retained earnings. Again, we are not doing anything new here, so make sure you catch the spirit here. Retained earnings by default has what? A credit balance. It's an income, so balance brought forward. In case there is a question and the retained earning is negative, you have to bring it to the debit side. Again, like I say always, don't let your brain be linear. Let your brain be malleable, because so that if you go to the exam and something comes, you don't become handicapped. you can just utilize the power of your brain and you get yourself out. So although in my pro forma, I am bringing it on the credit side, I am saying that in case you go and the retained earning figure is negative, you bring it on the debit side. Yo. Pretend they close the accounts. Again, we think it has a credit balance. If it has a debit balance, then the balance carried down will be on the credit side. Yo. Then profit after tax for the year it's gonna come here because you add that to your retained earnings by default. But if the company made a loss, we subtract it from the retained earnings. You know this already. If it is profit, you add it to the retained earnings. That's why we are bringing it on the credit side. If it was a loss, you bring it to the debit side of the retained earnings account. So loss for the year. So I'm going to put into bracket if any. Okay. So these two guys, only one of them will be there depending on the context of the question. By default, you balance the accounts. Certainly your balancing figure will be here and that will be the dividend paid. You don't need a miracle for that. That's it. So let me put these two guys in brackets because only one of them will be applicable. If the entity made a profit, credit side. If the P&L account is loss, debit side. Yo. But for corporate reporting students, we're going to get a little bit excited for you. And so when we are looking at dividend paid, we have to look at it from two perspectives. Because we will be looking at the consolidated cash flow statement, we have to look at the dividend that is paid to the shareholders of the parent and then the dividend that has been paid to the non-controlling interest. So for consolidated cash flow statement perspective, the dividend calculation will be splitted into two. What we did here is the default. FR students, no problem. No problemo. But if you are dealing with consolidated cash flow, thou shalt not do this. Thou shalt do this. So to get the dividend that we pay to the owners of the business, to the parent shareholders, we're still going to be using whatever the heck, the retained earnings, okay? We're still going to use the consolidated retained earnings. Don't forget about that. And again, we expect that it keeps a credit balance, but I've explained the implication to you already. Balance carried down like this here. Stay with me. If we are looking at the dividend to the parent shareholders, then we will bring the share of profit to the parent shareholders. For now, some of you, your brain may be in Wonderland. Just get it. Tomorrow morning, we will do consolidated financial statement and you will understand some of these things. So for now, just get it. Tomorrow when we prepare consolidated P&L account, you will understand what is coming up here. But get it. We will bring the profit attributable to the parent shareholders. That is, if we made a profit, the share of the parent will come on the credit side. If the consolidated P&L account was a loss, loss will be shared. So in that case, it will be on the debit side. So again, it could be on the debit or it could be on the credit. You just gotta know where the heck you are at. So here will be a loss, if any. Okay, again, sorry, loss. And again, we're gonna say if any, because only one of these guys will be present in a given question. Only one of them. Then you balance the account, and the balancing figure will be the dividend paid to the owners of the business. Okay, the dividend paid to the owners of the business. So to get a dividend, we pay to the parents' shareholders. We use the group retained earnings, and then we do the same thing. But then we have to also look at the dividend that we paid to the non-controlling interest. In that case, we'll prepare the non-controlling interest account. Remember, non-controlling interest is part of our equity. Okay, not remember. Maybe you don't have any idea, but note. So it's equity and keeps a credit balance. So balance brought forward. You pretend to close the account. Balance carried down. If during the year we acquired any subsidiary during the year, then the NCI that arose from the acquisition during the year will be brought here. So acquisition during the year, that's the non-controlling interest at acquisition. We'll bring it on the credit side. Give me a sec. Let's see if I can loop this down a little bit. Then get a difference, get a difference, get a difference. Corporate reporting, get a difference. Unlike the owners where we said we would take the share of the profit for the year, when we are dealing with non-controlling interest, we will take their share of total comprehensive income. That's it. So NCI's share of total comprehensive income, if it is a positive, meaning that the total comprehensive income is a positive figure, then it will come on the credit side. If it is a negative figure, you know already, it means it's a loss. So we take it to the debit side. All right? Meaning it's negative. Again, only one of these guys will be in a given question. We're going to pretend to close the account. The balancing figure will be the dividend paid to the NCI. I know it's like there is a lot of work going on, but if you look at it closely, you realize that it is the easiest work you can do. Only that your brain has to be reversing. Oh, what did they do? What then must I do? What did they do? What then must I do? But the reason why people like the normal P&L account is that in the normal P&L account, you're just going to ask yourself, what am I supposed to do? That's all. But in cash flow, you need to ask yourself, what was the result in the P&L? How do I present it for cash flow purposes? That is why it appears that in the cash flow, it's like it's a little bit challenging. But that is what brings out your understanding of the accounting standards. And if you can understand the cash flow statement, it means you understand the accounting standards. It means you can find any other part of the syllabus pretty easy. So again, just want to whisper into your brain, don't see this as too much work and write it off, because it may not end well for you. Okay? It may not end well for you. It's very important. All right. So that is my dividend paid. Like I said, corporate reporting students, we may have to, sometimes it's to be given. And that's why you say, oh, thanks be to God. You don't have to calculate it again. Just put it there. Other times it's not given, so you calculate it. Then the last item will be the capital repayment on lease obligation. So the capital element of lease payment. The capital element for lease payment. You see, for every lease that we pay during the year, there is a capital element, and then there is also the finance element. What we are bringing here is just the capital element. And I'm going to be explaining that to you in a moment. So probably that'll be all. We could get positive or a negative answer, and that is net cash flows from financing activities. We done. So we add the three results: net cash flow from operating, net cash flow from investing, net cash flow from financing. And that will give us either net increase if the figure is positive, or net decrease if the figure is negative in cash and cash equivalent. So if it is positive, you call it net increase. If it is negative, you call it net decrease. Then we bring in the cash and cash equivalents brought forward. That is at the beginning of the year. And again, that could either be positive or negative. If it's under current asset, it's a positive item. If it's under current liability, it's a negative item. Because like I told you earlier, the cash and cash equivalent we are talking about here is either cash or bank. And the bank figure can be under current asset, which will be positive, or current liability, which will be negative. So we do that, and that gives us the cash and cash equivalent at the end of the year. This is how we prepare the cash flow statement. But there is a last thing that I've not spoken about. One workings that possibly we may do in the exam hall is the workings for property, plant, and equipment. So let me go back to my default workings flow, not a CR people. This is the default, so we're going to be doing it here. Is property, plant, and equipment. Again, I just remembered an item that, I don't know, did I bring it up? Let me see. Under operating activity. I just remembered one item. Under investing activity, we brought in, stay with me. The proceeds from the disposal, right? But again, if you're a good financial reporting student or corporate reporting student, you know that the profit or loss from the disposal will be brought in the P&L account. So we have to adjust for that as well. So I can insert it in my slide, but you just have to know. It just occurred to me that we didn't bring it as I was now preparing the assets account. So if it was profit, they added it. If it was a loss, so sometimes we call it gain. So gain or loss from disposal of assets. If it was a gain, they added, so we'll come and subtract. If it was a loss, they subtracted, so we come and add it back. So that is the issue there. You thought we were done, but we are bringing in more items. Okay. So in our PPP or PPE account, slash in our currency sign, it's an asset. So assets keep a debit balance. So balance brought forward. All right. We're going to pretend to close the account. So have balance carried down. All right. Then maybe during the year, the entity did something. So some depreciation will come here. If we charge depreciation, it will reduce our assets. You know that already. Then we did a revaluation. Revaluation loss reduces our assets. So revaluation loss will be credited. If it was a gain, then it will be added to the asset. All right, so revaluation loss or impairment in the asset will reduce the asset. So you bring it on the credit side. Then during the year, if it happens that the entity leased some assets, so leased PPE, it will come on the debit side because it will increase our property, plant, and equipment. It will come to the property, plant, and equipment. If during the year the entity disposed of, so disposal of assets, not the proceeds, so the carrying amount, be careful. It is the carrying amount that you are deducting or you are bringing on the credit side here. The carrying amount of the assets that we disposed of, or maybe the cost. It depends on where we are working in. That's what, not the proceeds. Not the proceeds. Okay, so that will also reduce our assets, so we credit it. Then this is for corporate reporting students. If it happened that during the year we acquired a subsidiary, then the subsidiary's property, plant, and equipment will also be added to ours. So we'll bring in the subsidiary's PPE at acquisition. So this one is for just corporate reporting students. Let's put an asterisk on that. It's for just the corporate reporting students. Then there could be some transfers. An investment property could be changed into a PPE. A PPE could be changed into an investment property. You know the treatment already. You'll come and reverse it here. So if it happens that we change an investment property into PPE, why not? So transfers may come on the debit side. Transfers may come on the credit side. It all depends on the context of the question. Then we're going to get additional purchases. We're done. But this is what you have to understand. Stay with me. The additional purchases, the disposal, and the depreciation, these three items, always, maybe two of them will be given. The balancing figure will tell you the other. So stay with me. If the credit side happens to be more than the debit side, then the balancing figure will be referred to as what? Additional purchases. Does that make sense? Will be referred to as additional purchases. But if it happens that the debit side is greater than the credit side, then the balancing figure is on the credit side. In that case, it could be the depreciation for the year if we are not giving the depreciation. But if we are giving the depreciation, then that could be the carrying amount of the asset that was disposed of. Any questions? These are the things we must understand when we talk about the cash flow statement, IAS 12. And like I said, consolidated cash flow statement too, that's the swag we go. All right. So let's crunch some numbers and try to bring these principles to life. We're going to go to our evaluation of financial statement document, the ratio notes, because there's a question there that we want to use as a guinea pig to get ourselves up to speed with cash flow. That's question 6. And that is on page 11 of the evaluation of financial statement question kit. Question 6, page 11. Sit down. Screenshot. Okay. So slide 1. Slide 2, that's the pro forma. Operating activities up to the cash generated from operations. Slide 3, the conclusion of the operating activities. Slide 4, investing activities. Slide 5, financing activities. Then the workings for the operating activities. Interest and income tax, the default approach. Then the other income tax presentation, where it's otherwise. Retained earnings and PPE. Then this is for corporate reporting students, the goodwill accounts. And then the working capital movement. And then the dividend, calculating for dividend paid to the owners or the parents, and the dividend paid to the non-controlling interest. And that is all. Okay. So we go to the question. Like I said, page 11 of the evaluation of financial statement question kit, question 6. And we are looking at deltoid or deltoid, whatever the heck. in that case. But we'll take a short 5-minute breather and then we'll come back and come and wrap up with this question. Okay, so let's crunch some numbers and see how we can apply the principles generally in that particular case as well here. Let's see. I think we have some comments coming in on YouTube. Let's see if there is any question apart from that, and we can go for it. Matthias Nosigbe said, "Good evening, sir. I'm watching from Liberia." Okay, Matthias. Francis Nkole said, "Good evening, sir. I'm watching from Zambia." Okay, oh, Francis Nkole. Then Albert Pichua said, "Albert from Uganda. This is the first time I have caught your live lecture." Okay, Albert. Kevin from Kenya. Okay. Juani. Babatunde from Koi. Babatunde from Nigeria. Okay. I don't know. Do we have any question? Good evening, Shira. Shakunzi Noah from South Africa. Okay. Oh. Shakunzi. Kinsley Baden said, "So what if you start with operating profit so that you don't add the finance cost again?" Yeah, it's possible. That's an alternative presentation that can be used actually. Some people do that workflow so that you don't come and add the finance cost back again. You could do that if you want to present that way. That's acceptable as well. Only that, like per the marking workflow and the tick, I mean, you will lose that one tick of the finance cost coming in and then later on deducting it, but it's allowable. Abanga Benjamin said, "Good evening, sir." Okay, so I think it's all about greetings, no, you know, messages, other messages for me. Okay, all right, that's fine. So let me bring back my screen and let's go into the discussion. Okay, so this is what we have. Deltoid. Now, so I want you to stay with me carefully because all we are going to be doing is to apply the principles we just learned. That's all we're going to be doing. So let's go read the requirement. What the heck does it say? Prepare the cash flow statement for Deltoid for the year ended 31st March 2010 in accordance with IAS 7 statement of cash flow using the indirect method. I've already told you about that, right? Using the indirect method. It's not anything new. And so we don't have any problem really about that. Based on the information available, advice, okay, we'll come to that. Okay, so the cash flow statement. So deltoid or deltoid, whatever, because these are two vowel sounds, so we can ignore the second one. Statement of cash flow for the year ended 31st March 2010. Okay. What is the currency workflow? It's dollars. I think there is 3 zeros up. Yup. So 2 cash columns. 3 zeros up. And we're going to be starting from where? Cash flow from operating activity. Cash flow from operating activities. Okay. And then, so we put this pro forma down or the presentation. Then I'm going to go on the next sheet, which is going to be my working slide. Because like we know, we are going to be setting ourselves up to do a couple of workings by default, isn't it? So let's go. What did we say we start with? Profit before tax. So let's scan and read the question a little bit. The following information relates to the draft financial statement of Deltoid Limited. So we see their financial position. Remember we said, again, principles. Just go back to the very first slide we spoke about. We said for the profit or loss, our focus will be on the current year profit or loss. But for the statement of financial position, our focus will be on both the current year and the previous year. Right? That's very important. That's very important. So let's go back to my slide. In the position, we are giving 2 years. No P. We're seeing things that are happening. One thing that we want to really spot on will be current assets, the bank figure. Stay with me carefully. In the current year, which is 2010, please always be mindful of the arrangement of the dates. Sometimes the examiner can interchange it, so you got to be careful. But you are seeing nil here, Zokbo. So it means under current liabilities, you can see bank overdraft here, currently 1,004. It means that when we prepare our cash flow statement, our final figure should be negative 1,004. Then it means the cash flow has balance. That's the deal. That's the deal. So we're going to go into it because there's a note to the question. But let's see the P&L. You can see statement of profit or loss. Now, stay with me carefully. The examiner has given you profit or loss for the 2 years. But what did we say? Profit or loss, our focus is always on the current year. So why did the examiner give the previous year? He loves you. He wants to give me so that I fail. Nobody wants you to fail. You just have to know what you're supposed to use. The fact that there is information available, that doesn't mean you need to use it. So in the profit or loss account, we don't need the previous year data. But it's a comparative thing, so the examiner will present it to you sometime. But we don't need that. Our focus is going to be on the current year. Now stay with me. We say that we will start with a profit before tax. But it is actually a loss. Okay? It's actually a loss. 1,008. Nonetheless, we're going to start with that. So that's a free tick. We don't need a miracle for that. So we say loss before tax. 1,800, and it is negative because it's a loss. Okay, it's a loss. What did we say we do? The various adjustments. Now again, although from the pro forma we move from depreciation and in the operating activities, let's just go back to the slide. Let me show you something. Up until where we dealt with the working capital situation, you can, bring whatever you want to bring first. It's not necessarily that it has to follow that order. Does that make sense? So you can bring whatever you want to bring first when it comes to the way you do the presentation. So let's go. Still in the P&L account, you can see there is finance cost here that has been charged in the P&L account. It's 1,000. If you remember, we said the finance cost charged in P&L will be what? Added back. So since I'm in the P&L, taking some easy takes, let me go and add it back. Again, like I said, it's not statutory that the thing should follow any order, right? So I can bring my finance cost. 1,000. It was subtracted, so we add it. Let's go. So that's all I need for now from the finance cost. I may need from the P&L account. I may need the profit for the year to calculate dividend. And that is under the financing activities. I could go there and calculate the dividend and bring my figure there. Again, it's about knowing the workings I'm supposed to do, so you can get the easy marks as fast as possible. So I could go and do my investing activities and then, financing activity, and do the retained earnings and get a dividend payable. But I'm going to take it a little bit slower on that one. So let's read the additional information, because that's where we're going to see various things that must be done in that regard. What is she saying? The finance course has a note. Don't you have to read it first? We will come to the note. What has been charged in the P&L account, we have to adjust for it in the operating activities first. So what has been done in the note, we will come to it. But what has been charged in the P&L against the profit or loss must be adjusted for. The note will not change that adjustment. Are you getting it? So we'll come to the note. That is where we will know how much we are supposed to actually pay. But what has been charged in the P&L account has to be brought. Okay. So let's proceed and see what we can do in that particular case. Note 1. Please stay with me. The following additional information is available. Property, plant, and equipment is made up of leased property. Oh, stay with me. Last year there was 800 of leased property, but now it is nil. Okay, we don't know what's happening there, but don't worry, we will know in a moment. So stay with me. On plant, we are seeing that it is reducing. Again, we don't know what is happening, but we will get a memo very soon. Next, leased plant, we are seeing that it is going up. By virtue of that, it means that there were some new leased plants during the year. Again, don't worry about it, we will get the memo because there's a note about it. So leased property, there was a figure last year, but in the current year there is no figure. It means it might have been disposed of, but the examiner will give us details about that in a sec. So let's go. During the year, Deltoid sold its leased property for 8.5 million. 8.5 million. Stay with me. That's the proceeds. So that 8.5 million is the proceeds. Without thinking too much, where would that go? Investing activity. I have a luxury of space. You can also have a reasonable space and work yourself out. You don't have to wait and work for one and come and work for the other. In the exam hall, you don't have time. As your brain is producing the answers, you just create a column and bring it in. So cash flow from investing activities. So we bring that up in this particular case, and that is going to be the proceeds from the disposal of leased property. That's too much, Nhyira, because I need to put that in the first column, the 8,500. It's an inflow. Sounds good? So it comes here. Let's continue. And entered into an arrangement to rent it back from the purchaser. Yeah, we know your brain is going IFRS 16, sale and lease back. Forget it. We don't need it here. Forget it. We don't need it here. How do I know we don't need it here? Because we don't need it. So why did the examiner say it? Because he loves you. That's all. There were no addition to or disposal of own plants during the year. Stay with me. So when it comes to the own plants, there were no addition, neither were they disposal. So we won't touch it. There were no addition, no disposal. So we won't touch it. Last sentence. The depreciation charges to cost of sales for the year was in total 3,700. What did we say? Go and adjust for that in the operating activities. Depreciation 3,700. We're going to add it back. That's the total depreciation. But be careful here. Something is going on. It looks like we finished reading that note. But some things are not adding up yet. Number one, the lease property they sold, we've brought the proceeds and the investing activity. But if you remember, we said gain on loss on the disposal of assets must be adjusted for where? In the operating activities. So we got to do workings for that. So workings 1. Leased property. So stay with me. The opening balance was 8,800. Again, you may not sometimes do the T account always. Sometimes you can, do the workings on the face of the cash flow statement if you are comfortable with it. But I'm in class, so I'm taking my time on some of these things. So balance brought forward is 8,800. Stay with me. On that lease property, we charged a depreciation of how much? 200. And depreciation will go to the credit side. We balance the account, then the proceeds we got from the leased property, which was how much? 8,500. What's the double entry? Debit cash, credit the property. So we credit it with the proceeds, or if you want cash, whatever the heck. 8,500. Balance the account. The balancing figure will give us the gain or loss, which we will adjust for in the P&L account. Which we will adjust for in the P&L account. So that is 8,800. 8,800. So the balancing figure is here. If the balancing figure is on the credit side, what does that mean? It means we made a loss. So loss, which was charged to the profit or loss account, is 100. So this 100 loss was subtracted in the P&L account. So what do? We go and add it back in the operating activity. Any questions, you raise your hand, we'll bring you up, or you put it in the chat for me. Workings 100. So that is the first thing that the examiner didn't tell us, give us information, but he gave us the sales, and we realized that the asset had no balance at the end of the year because they had sold it. So immediately they have sold an asset, we need to find out what is the gain or loss on the asset. But that is not all. We are seeing also that the entity leased an asset, because if you look at the leased plant, let me clean some of my lines, because again, some things are not going to be clear. You are going to pick it up. If we look at the leased plant here, it's going up. And I told you that this means there's a new lease. But the examiner has not given us any information. So the question we ask ourselves is, what was the new lease we had? We have to figure it out ourselves. Now remember, leasing an asset is not a cash item, but we need that new lease so that we can get the amount of lease obligation or capital element payment to the financing activity later. So workings 2. Leased plant. So let's go. Last year it was 2,500 on the debit side. When we pretend to close the account, this year our closing balance is how much? 6,500. Stay with me. The leased asset, we charged a depreciation of 1,008. That will be on the credit side because depreciation we credit the asset and debit PPE. Sorry, and debit profit or loss. So we credit it with a depreciation on the leased asset. And that is 1,800. We are done. You realize that the credit side is more than the debit side. So the balancing figure will be the new lease for the year. What will be our balancing figure? So this is our new lease during the year. Let's get a balancing figure for the year. That'll be 7,000, 8,300.
$5,800.
Okay. 5,800. Like I said, leasing an asset, there is no cash going out or coming in. So this figure is not because we want to bring it under investing activities, because in the question we were told that there were no addition or disposal of the own plant. That's why we are not touching the own plant. We are not touching it because there was no addition, there was no disposal. Now, this is the leased asset. But we are not done. We need to look at the lease obligation so that we can know the capital element of the lease obligation that we paid for. And that is workings 3. So lease obligation. Lease, yes, Evelyn.
Nhyira, please, the owned asset. You say we wouldn't touch it, but I can see that in the prior year it was 14,200 and it's now 12,500 in the current year. Isn't there an issue of either impairment or revaluation loss?
Have you considered the depreciation figure? You
Okay,
can
so that's
work
why
it
I'm
out and see if
okay.
if it's balancing or it's not balancing.
Okay.
So you can work it out. 14,2, 12,5 gives you 1,007. So it's balancing itself. That's why
And
you
so
don't touch
that's the
it.
depreciation figure.
Yeah.
Okay. Thank you.
All right. Now, lease obligation keeps a credit balance. So you're going to go to the statement of financial position to pick the lease obligation. Usually it will be under both current and non-current. You bring both. So balance brought forward, current. Let's go. Last year, it's 2,000. Non-current is 800. So 2,000. Non-current, 800. You pretend to close the account. Balance carried down. Current. The current year figures. That is what? 4, 8, and 1,007. And that is the non-current element. Then remember the new lease asset we got during the year from Workings 2. It will increase our lease obligation. So new lease from Workings 2, 5,800. We balance this account. The balancing figure is the capital element of the lease that we paid during the year. So what do we have? 2,800, 5,8. That's 8,600. Minus 4,8, 1,007, and that's 2,100. So that is the lease payment, which will go under the financing activities. Again, I could pull that up in my slide. Cash flow from financing activities. Lease obligation payment from Workings 3 to 100. That is the idea about the note 1 we read. So from the note 1, we have brought depreciation, we have brought loss on the disposal of the property. We got an item coming in under the investing activity. We got an item coming in under the financing activity, and we have done 3 workings. Again, it depends on the context of the question. It depends on the context of the question. Okay. Let's continue. Workings 2. On 1st July 2009, okay, remember, our year ended is 31st March 2010, which means it started on 1st April 2009. So on 1st July 2009 is within this current year. There was a bonus issue of shares from share premium of 1 new share for every 10 share held. 1 new share for every 10 share held. Okay, so the question we ask ourselves is, what the heck is going on? That information there is talking to us about equity. About equity. As you can see here, you can see equity into bracket note 2, share premium into brackets note 2. So it is talking to us about equity. Now, really, we are going to be excited about the share capital. So I could pull up my workings 4 on the share capital perspective. Or if you want the equity shares. So the opening balance is brought, which will be last year's figure, 8,000. We pretend to close the account and bring the current year figure, which will be 10,000. Stay with me. Then they said they did a bonus issue. I told you about that a moment ago before we started to solve the question when we were dealing with the principles. I said bonus issue doesn't bring cash, right? Bonus issue does not bring cash. But what is the concept there? 1 new for every 10. 1 new for every 10. So the question we then ask ourselves is, what was the bonus issue? Let's go back to the question. You can see that the equity share is $1. So it means the number of shares is also 8,000 shares. Does that make sense? The number of shares is also 8,000 shares. Now, again, if you are looking at the share premium, you realize that the share premium is falling by 800. Please see what is going on. We are not doing any magic here. They said they did the bonus issue from share premium. That was the language. So the share premium is falling by 800. So without any miracle, I could say that then the bonus issue is 800. I could say that. And I will be right. But let me show you. Go read it. It says 1 for every 10 held. So at the dates that we did the bonus issue, 1st July 2009, what was the number of shares people were having? They were having 8,000, the opening figure. So it means it's going to be 1/10 by 8,000, which will be 800, being the share premium reduction value. No miracle. But remember, that is not a cash item. That's not a cash item. You need to remember that very well. Let's continue. On 1st October 2009, there was a fully subscribed cash issue of shares at par. That is what we are excited about. So now, let's balance this account. The balancing figure becomes the cash issue that will go under the cash flow from financing activities. So 10,000, 10,000, balancing figure 1,002, and that is the cash issue. It's like cashew. That's it. So your share capital is going up by 2,000. But 800 of that is bonus issue. Only 1,002 is the cash issue. That is what we are interested in. So issue of shares, 1,200. We are done with the notes 2. Very sweet, simple, straight to the point. Next one. The 10% loan note is due for repayment. Again, just listen to the English. The 10% loan note is due for repayment. They didn't say they have paid it. They said is due for repayment. On 30th June 2010, Deltoid is in negotiation with the loan provider to refinance the same amount for another 5 years. We don't care. Moreover, 30th June 2010 is event after the reporting period. It doesn't relate to 31st March 2010. They are renegotiating into them. Have they paid? No. Did they get more? No. So for that loan note, the 10% loan note, we won't touch it. Oh, sorry. Where is it? Okay, so it's here. We won't touch it. So be careful. Again, look at what is happening here. Last year, it was under non-current liability. But this year is under current liability. Why? It's because it is due for repayment in less than 3 months after the year end. So nothing is happening. They've not paid it. They still owe. So we won't bring anything about it on the face of the cash flow. You get it? Yo. So why were we giving that note? Again, to tell you a story. Because, I mean, the exam is about stories. You have to know which of the stories apply and which of the stories are there to just have fun with you. Note 4. The finance costs are made up of, finance lease charges, overdraft interest, loan note interest. But we don't care about that. We don't care about that, really. It's just giving us a breakdown of the 1,000. So, M-Fashe, MIA, it won't give us anything. Again, why did the examiner tell you that? He just want to tell you what it is made up of. That's all. So we go to the financial statement under current liability. And let's find out, is there anything about interest owings? No. There is nothing about interest owings. So what does that mean? It means that the interest or finance cost that we added above will bring the same finance cost later on as what? Payment. As payment. Okay. So that's all. Let's wrap it up and bring in working capital and get the hell out of here. Can I have an answer here? The net figure from this one. Then we can bring in the movement in working capital. What do we have?
3,000.
Now we can work for the working capital. Let's go to the financial statement. P&L position, sorry. Under current assets, what did we say? Look at inventory. What is happening to the inventory? Inventory is increasing. Increase in current assets means what? L'argent au revoir. Money is going out. So it's an outflow. So we go increase in inventory. What do we have? Let's see. 12,546. Let's see what we got. 7,900. Money is going out. So we subtract. Next one. Trade receivables. What is happening to it? It's also increasing. Again, money is going out. What's the difference? 4,500 against 2,000. And that is going to give us 2,500. L'argent, les pas, les poi is going out. Next one. Tax refund due. Oh, we will come back to that. Because if you remember, we said movement in working capital excludes tax issues. So don't get any ideas. And the bank also don't get any ideas. We'll come back to them. Then let's go to current liabilities. Please. The 10% loan note here, we've already discussed its implication. The tax issue, we'll talk about it in a moment. Bank overdraft, we'll talk about it in a moment. Finance lease obligation, we've already spoken about it. Trade payables. What is happening to the trade payables? It's also increasing. So increase in trade payable, it's also what? That's an inflow because it's the reverse of current asset. And that is 4742. That's 500. That's our movement in working capital. We're done. We're done. Give me cash flow from operation. Cash flow from operations. $6,900 negative. Right. Then after that, we bring in the interest paid. And we said since there was no finance cost under the current liability or interest owings on the face of the statement of financial position, the amount we added above here, 1,000, will be the same amount we paid. Uh-oh. 1,000. But then the income tax, that we need to work for it. So let's go back to our working slide. And that will be workings 5. Income tax. And I want you to stay with me carefully here, because the context of the question tells us or will direct us what the heck we are supposed to do. So let's go to the financial position. Ooh. Stay with me carefully. Now, under non-current liability, we see deferred tax. Last year, 800. So bring it up. So balance brought forward. Deferred tax. 8,000. Hey, was it 8,000 or 800? Okay. Then come to the current liability. Last year, current tax is 2,500. Stay with me. We're going to pretend to close the accounts to bring the closing balances. Deferred tax currently is 1,002, still under liability. So balance carry down 1,200, and that was what, deferred tax? But you realize that if you come to the current liability and look at the tax there, it is nil. Why? Because the figure is actually under the current asset as tax refund due. and it is 500 under asset. And assets have a debit balance. So the brought down will be on the debit side so that the carried down will be on the credit side. This was what we were discussing. Yes, Patrick.
Please, I'm confused. So take that part again.
Confused about what exactly?
Confused about the treatment of the tax. The one you just did right now, the 500. Please take that part again.
So the tax under current liability for the current year, it's nil. But instead, we are seeing under current asset that we have tax refund due. It's under current asset. An asset keeps a debit balance. So when we bring it on in the income tax account, the brought down is on the debit side. So the carry down will come on the credit side. The deferred tax was still under liability, and liabilities have a credit balance. So the brought down is credit. That is why the carry down is on the debit side. That's what we're talking about. It's an asset. It has a debit balance. So brought down or carry down becomes a credit balance.
So it's due. So this is more or less like we are paying it off.
It's under current asset. The language is tax refund due. Tax refund due. The key word here is refund, and it's under asset. So they will receive it from the government. So that is why it's under current asset, not we paying it. That's the concept here. So it is tax refund due. So it's under current asset. It means the entity is the one who will be receiving it. If the entity is the one who is to pay, it wouldn't be titled as tax refund, number one. And number two, it wouldn't be under current asset. That was the principal explanation that we did earlier when I was explaining the income tax. Okay. Then, what did we say? We go to the P&L account and find out the income tax charge for the year. Stay with me. What are you seeing here? Look at the P&L account. It says income tax relief. It is what? A positive figure. What did we say? We said if it is a positive figure, it means it's a benefit we're going to get. Hence, we bring it on the debit side of the income tax account. So charged for the year will be on the debit side. That's P&L, 700. Now we can balance. The balancing figure will be the tax paid for the year. This was what we were explaining. So you realize this question is not in the default approach. It's in the non-conventional approach. But you just have to understand how the principles apply, how IAS 12 is, and boom, you're good. So we balance that out and see what we have as the tax paid for the year. $800 to
3,008. 3,008.
As the balancing figure.
Balancing figure is 1,009.
1,900. Okay. Oh.
Yes, please.
So that is the tax paid. This is the figure from Workings 5 we will take here. 1,009. We are done with operating activities. Let's get a net cash flow from operating activities. I'm going to just put it below there. What do we have? Oh, some negatives here.
9,800 negative.
9,800 negative. Okay. So that is our net cash flow from operating activities. Very sweet, simple, straight to the point. Very sweet, simple, straight to the point. Okay, let's finish. Investing activities. Is there anything else that we need to bring? We didn't hear anything apart from the disposal. They didn't sell any other assets. Under non-current asset, they don't have any financial investment. They only have PPP, which we've dealt with. So it's more or less like that's the only item we'll have here. So net cash flow from investing activities. And that's 8,500. It's positive. Okay, it's positive. Then let's finish up on the investing. Investing, we've brought issue of shares, the repayment. So go to the equity because it's changes in equity. We've brought the issue of share issue, but we've not brought dividend, right? Because you can see the retained earnings is going down. So we need to do dividend. We were not also told whether any dividend has been paid. But always we have to do the calculation using the retained earnings to find out if it doesn't balance, then that means the entity paid some dividend during the year. So let's go to workings, whatever the heck, 6. We prepare the retained earnings account to help us to get dividend paid. So let's go. Retained earnings keeps a credits balance. Last year is 6,300. Pretend to close it. This year is 4,500. Oh, 4,500 for the current year under review. Then we go to the P&L account. What happened in the P&L? The company made a loss. Loss will be subtracted from the retained earnings. So it will be on the debit side of the retained earnings account. So loss for the year, 1,100. There was no revaluation and transfer from the revaluation surplus to retained earnings. If there was, we will adjust for it. But there was nothing like that. So we balance it up. 6,3. 6,3. The balancing figure will be the dividend paid. How much we got?
700.
700. So that is the figure we take to the financing activity as dividend paid. From working 700. And it appears we're done. So let's get a net cash flow from financing. That's 1,006 negative. Then we can add the 3 up. So negative 1,006 plus 8,500, which is the net cash flow from investing, minus 9,800, which is the cash flow from operating. And it is still negative 2,900. So that will be net decrease in cash and cash equivalent, because it's negative. Then we bring in the cash and cash equivalent at the beginning of the year. Brought forward. And that is where your bank that we spoke about will come in. So check it up. In the current asset, there is bank there. Last year is 1,005. So that's the opening figure. We do the arithmetics, and that gives us the closing figure, which is negative, and that should be equal to the bank overdraft figure on the face of the statement of financial position. So plus 1,005 is negative 1,004. What is the overdraft figure on the face of the statement of financial position? Negative 1,400. So it means our cash flow statement has balanced. This is how we prepare the cash flow statement. That's it. Very sweet, simple, straight to the point. Once you understand the principle and you know what you are expected to do, and you understand what had happened already in the financial statement, then there is not going to be any problem at the end of the day. Okay, so that is it about that. And we're going to be wrapping up here. Tomorrow morning, we're going to go into consolidated financial statements. That is our question 1, the final part of our syllabus, consolidated financial statement, tomorrow. So the FR students, you'll be joining tomorrow's class as well. In that case, then we see how far we can go tomorrow on the consolidation. Then we will see what else we can do in that regard. Next week, we are starting with the Executive Revision Masterclass, and the timetable has been posted on the page. And so we're going to have a class somewhere in the week. Before Friday, you'll be writing the mock. So next week, Friday, financial accounting students, you are writing your mock in that particular case. So you take note of that. And after the mock, we then go and begin the discussion, and then find out about what is to be done generally in that particular case there. And then this is the final slide on that. Yes, Patrick.
Nhyira, please, the performance evaluation test we wrote some weeks ago, I haven't received my scripts if they have been marked.
The scripts have been marked. I have to check whether it has been sent. Script has been marked already. I have to check whether it has been sent.
And the ratios questions you made us write the notes on. The report on. Yeah, I did mine and sent it. That one I haven't received it.
That we have not sent out. I think that one we received like 5 or 7 scripts. So it'll be marked and sent to you, and you'll be have to discuss it with you.
Okay, thank you.
Nhyira, please, the slide on the lease plant again.
The what?
Slide on the lease plant, the workings.
Okay. So next week, Friday, mock FR students. Next week, Saturday, mock CR students. And from there, the following week, we will wrap up by discussing the various things that has to be discussed. But like I said, in the course of the week, we have a class before the Friday will come in that particular case. Yes, Clement.
Isha, please, will we be meeting tomorrow evening?
I can't confirm. You can check the timetable. If there is a class that relates to your class, then definitely we will meet.
Yeah, since I'm FRCR masterclass, IFRS masterclass.
Oh, okay. All right. So that's it. Tomorrow, 8:30, we will continue with the discussion. And like I said, we will start with consolidated financial statements and then see what we can do from there. Says what? Please, would the CR students write the FR2? No, focus on your CR. You'll be writing it in on Saturday, so you focus on your CR and steady. All right, so that's it. See you tomorrow morning, 8:30.